Now, covered call style ETFs have gotten extremely popular, especially within the last few years. Things like the yield max option income strategy ETFs have been popping up left and right, offering investors the potential to earn a substantial amount of income consistently. But as we've seen some of these strategies play out, they've been less than optimal for investors. Now, even other names like QYLD in the past are also down 28%, and this is sort of a shame because the covered call style strategy is supposed to offer investors a relatively low volatility investment with a plethora of income on a consistent basis. So in this video, I want to talk about exactly why some of these covered call style ETFs seem to be decaying over time, explain to you exactly what's going on here, the actual mechanics of it, because a lot of you are probably interested. But on top of that, I'm going to share with you some super high quality covered call style ETFs that have not only not decayed, but also grown in price substantially since inception. So if you're an investor that's seeking income like myself, and you're interested in these covered call style ETFs, I promise you, you're going to want to stick around, drop a like down below, and let's get right into it. Real quick, for those that haven't already, make sure to go to the first link in my description and grab my new dividend investing ebook, where I share exactly how I went from $0 invested to now earning over $6,000 on a monthly basis and over $1 million invested in the markets. Along with the ebook, you're also going to receive my custom dividend tracker, where you can track your dividend progress on an ongoing basis and reach your dividend investing goals. So make sure to grab yourself a copy of my dividend investing ebook and the new dividend tracker today. It's the first link in my description. So first, let's understand the basics when it comes to covered calls. This right here is from investopd.com. It says covered calls are a neutral strategy, meaning the investor only expects a minor increase or decrease in the underlying stock price for the life of the written call option. The strategy is often employed when an investor has a short-term neutral view of the asset and for this reason holds an asset long and simultaneously short via the option to generate income from the option premium. Now, one of the main important aspects of the covered call strategy is that when you're selling covered calls like the fund managers do at yield max or of course QYLD, etc., they're picking a strike price and basically hoping that the underlying trades within the given time frame up until expiration date in order to earn a ton of income but also sort of protect the underlying. Now, because of the covered call overlay and the strike price being set, a lot of times when you're talking with an underlying that's volatile, if the underlying shoots up in price very, very high, the call seller is only going to be able to retain so much profit because your profit is basically capped when the underlying shoots up in price. But here's the important part. If the opposite happens, that's not necessarily the same case. If the underlying drops in price significantly during the time of expiration, the cover call overlay is going to protect a little bit because of course that premium that was earned by selling the call option, but it's not necessarily going to protect it all the way down, especially in the context of more volatile stocks and ETFs that do have the potential to drop significantly in a short time frame. I'm talking about things like the NASDAQ or things like Tesla, different stocks or ETFs that have a relatively high beta. Now, because of this limited upside, but not necessarily limited downside, a lot of times the cover call strategy can be seen as something like we see right here from the yield max Tesla ETF. And this is basically because over time, the underlying stock that's referenced is Tesla, and Tesla's moves are going to be based off, of course, the call options that are set along with Tesla's trading within the given time frames, etc. So although the cover call strategy can be extremely profitable, I use the cover call strategy across my portfolio on my single stocks I hold, as well as different ETFs. And on top of that, I love buying into different cover call style ETFs alone, which we're going to go through a few of them in this video. The cover call strategy does have some downsides, like I said, especially if you're trading in a market where the underlying consistently is volatile and or dropping in price. Because with that volatility, sure, it comes with larger option premiums, which the call seller can earn, and of course can sort of soften the blow. If the underlying drops significantly, the ETF is going to drop in price, and then it's going to take a long time to regain to where it previously was because of that strike price, basically capping the upside. So there's lots of different covered call style ETFs across the market that you do see basically trade sideways to downward. We see Tesla on the max time frame is down 65%. We see QYLD is down around 28% in the max time frame. Another one, RYLD, is down 36.1% in the max time frame. Even though all three of these different names offer a ton of income potential and honestly have paid out a ton of income, every single one of these have during this time frame, all that income is still at least somewhat offsetted because of course your underlying holding is decaying in price like crazy. Now, is there a way to combat that? Well, of course there is. There's for one different underlines that you can track. There's of course different strategies and different covered call style ETFs that might track different underlying and or have a more conservative strategy, something like JEPI or even JEPQ that are up around 18% in the max time frame, or for JEPQ around 11% in the max time frame. Now, the crazy thing is either one of these ETFs have still definitely underperformed the overall market during these timeframes and definitely underperformed the underlying index that they track. But still, when the cover call strategy is done better or quote unquote right, there is a ton of income to earn consistently, which JEPQ and JEPI have both paid to investors consistently, and all along while the underlying ETF that you're buying into, JEPI or JEPQ, has not at least went down in price. There's also other covered call style ETFs that have done this much better, something like the NEOS ETFs, SPYI, or even QQQI. The cool thing about these newer NEOS ETFs is that they don't only sell calls, at times they're also going to buy calls, which could give the fund some upside potential in rising equity markets. So I think it's really important to sort of gain some nuance and really understand what the underlying strategy is for the covered call style ETF that you're buying into. Really try to figure out exactly what the yield max, for example, strategy is, and if you think it's conducive or not to your strategy for investing, and if not you think it offers a little bit too much risk. Because even though investments like JEPI or JEPQ, like I showed you, even though these investments don't offer a 20, 30, 50, 100% yield or distribution rate, quote unquote, these ETFs have offered strong, consistent 12% annual returns over the last several years, which I personally as a holder have no complaints about. Another great example of a cover call style ETF that I think is also doing it right is GPIQ, the Goldman Sachs Nasdaq 100 Core Premium Income ETF. Now this ETF offers a similar cover call strategy to other cover call ETFs, but this ETF dynamically sells call options, which means there is the potential for much more upside, at least potentially during rising equity markets. So I think the bigger underlying takeaway is that not all cover call style ETFs are created equal. Like look at this one, for example, that tracks the Nasdaq 100, and compare it to QLD that also tracks the Nasdaq 100. Even though a lot of these covered call style ETFs are very similar, they all do for the most part have their own unique strategy, which makes it confusing for us investors, but also there's so much potential out there, and it really feels like there's a specific strategy for every individual investor out there these days. So how do you choose the right covered call style ETF for you? How do you earn a ton more income across your portfolio a lot faster than other traditional style ETFs? I think you have to do the research. I think you have to watch videos like this, learn a little bit more about what each of these covered call style ETFs offer, learn how they work, look into their actual strategy. And once again, ask yourself, is this strategy too risky? Is this strategy a bit too conservative? And of course, is this strategy right for me? Now also I have to say that I do talk about some of my favorite covered call style ETFs across my channel all the time. That's more or less all I talk about in this channel. So definitely look through some of my other videos if you want to go into a deeper dive on some of the popular ones across the market. So now that we talked about the covered call strategy and I explained to you guys why a lot of times these sort of investments seem to decay in price, I lastly, most importantly, want to hear from you guys down below. Out of all the covered call style ETFs in the market as of right now, what is your number one favorite? Drop the ticker symbol in the comments down below. If you enjoyed this video, make sure to please drop a like and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.